This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, in the last lecture, I showed you how we deal with an issue of shares. We credit share capital with the nominal value of the shares. If we were charging more than nominal value, the extra is called the premium, and we credit that to the share premium account. In this lecture, I want to look at two ways in which shares are issued. If a company wants to, rights issues, bonus issues, as you can see. If a company wants to issue more shares, they can issue them to anybody. You know, we call it a public issue, where you advertise there are new shares for sale and invite anyone to buy them. However, for a small company, that's not very easy. You know, if you're a tiny company, just a group of friends, it might be a bit difficult to find new people who want to buy shares. And even for a big company who might do this, it's an expensive way because you have to pay for advertising and all sorts of things. And by far the most common way of raising more money by issuing shares is what we call a rights issue. And although it's all typed out there, let me explain. A rights issue is an offer of new shares to existing shareholders. So what happens is the shareholders, the current shareholders of the company, get a letter asking them if they want to buy more shares. They don't have to buy them. In the exam, we always assume that it's what we call fully subscribed, that people do buy them. But you just get this letter saying, you know, do you want to buy more shares? If you do, tick the box, send the money. If you don't, you can throw the letter away, or maybe you could sell it to somebody else. But I'm not worried about that. It's an offer of new shares to existing shareholders. Two things, though, that are very important, as you'll see when we look at the numbers with an example. One is they must be offered fairly. What I mean is, if we want to issue 1,000 new shares, you can't just write to one shareholder and say, do you want to buy another 1,000? All shareholders have to be offered new shares. And when I say fairly, it's always expressed something like this. For example, a 1-for-5 rights issue. And what that means is you'll be offered one new share for every 5 existing shares. So you see, if at the moment you own 100, you'll get a letter, if it's 1-for-5, saying, right, you're entitled to buy another 20 shares if you want. On the other hand, if another shareholder currently owns 500 shares, at 1-for-5, they'll get a letter offering them another 100. So that's what I mean by fairly. Every shareholder gets a letter saying you're entitled to buy 20 shares, 100 shares, whatever it is. And again, although in the exam we always assume they do buy them, they're not forced to. The letter is just offering them new shares. So that's what we mean by a rights issue. The other one is going to sound very strange, but I'll explain why they might do this later. But something called a bonus issue. And this time, instead of offering shareholders the right to buy new shares if they want to, you know, they may not want to because they have to pay for these shares. A bonus issue is an issue of new shares, again to existing shareholders, but this time they're simply given free of charge. So here is a rights issue. You get this letter saying, do you want to buy 20 new shares or something? With a bonus issue, you just get new shares sent to you in the post. You're not having to pay for them. You just end up with more. Now, I say that may seem strange. Why would they do that? Well, I'll explain why they might do it after. But if they do it, they do it. Just as with a rights issue, they must be issued fairly. So again, it might be 1 for 5. They give them 1 new one for every 5 they currently hold. It could be 1 for 3, 1 for 4, 1 for 2. It's always expressed in that sort of way. Finally, before we look at the example, in both cases, the new shares, there are going to be new shares, obviously. Rights issue, they're having to pay for them. Bonus issue, they're giving them free. But the new shares will have the same nominal value as the existing shares. All right, let me show you how this works and how you could be asked in the exam. Example 4 is exactly the sort of question that you could be asked in the exam. At 31st of December 2004, a company's capital structure was as follows. The ordinary share capital, 125,000, and always be very careful here. These, it says, are 25-cent shares. That's the nominal value. And therefore, you didn't actually need to be told if the nominal value is 25 cents each and the total share capital is 125,000, that must mean there are 500,000 shares in issue. 500,000 nominal value 25, 125,000. There's also a share premium account of 100,000. What does that mean? It means when they issued those 500,000 shares, or some of them, in the past, they must have been charging more than 25 cents. And any extra went to share premium. During the year ended 2005, the company made a rights issue. We'll look at the detail when we need it. But later in the year, they made a bonus issue. And the question wants to know what would be the balances on share capital, share premium at 31st December. Now, although I have shown you the double entry issuing shares and it doesn't change, in this sort of question, far more sensibly, far quicker, far safer than actually doing debits credits, which wouldn't be asked here, is to do it the way I'm about to. I always do a little table. And I have 3 columns. Number of shares, share capital account, and share premium account. Well, we know how we started the year. At the end of 2004, the beginning of 2005, brought forward there were 500,000 shares. The total share capital at 25 cents, 125,000. And the total share premium, the extra they'd paid at some stage, 100,000. Now let's work through in date order what happens. During the year to December 2005, the company made a rights issue of 1 share for every 2 held. Well, at the moment there are 500,000 shares in total, so if everybody's offered 1 for every 2, surely 500,000 shares, 1 for 2, they're issuing 250,000 more shares. And as you saw in the last lecture, the nominal value of those shares goes to share capital. And as I did say a few minutes ago, the new shares are always the same nominal value as the existing ones. So here they're 25-cent shares. And so to share capital, 250,000 at a nominal value of 0.25, 62,500. However, how much did they pay? They paid $1 per share. And so they paid extra. 25 cents was the nominal value. If they pay $1, the extra is 75 cents. That's the premium. And the premium is credited to share premium. So 250,000 shares at a premium of 75 cents each, 187,500. And check you're happy with that. You see, we issued 250,000. They paid $1 each, so the cash we received was 250,000. We credit share capital with that much, share premium with that much. The total we're crediting is 250,000. So how many shares are now in issue? 750,000. It says later in the year, the company made a bonus issue of 1 share for every 5 held. Well, it's always, whether it's rights or bonus, the proportion of how many shares they currently do hold. And they now own 750,000 in total. So 1 for 5 means we're issuing 750 divided by 5. I should be able to do it in my head. Another 150,000. Now what are we going to do? First of all, these shares must be 25-cent shares again. They must be. They're always the same type of shares. The original shares are 25 cents. And so if more shares have been issued, share capital goes up. At 25 cents a share, it goes up by 37,500. But we have a problem, because these shares were given free. We've not received any cash. If you receive cash, debit cash, credit share capital, fine. But we've not had any cash. They've been given them free of charge. And so the total owing to shareholders can't change. If shareholders haven't paid in any extra money, they can't be owed any extra. You know, before we made this issue, shareholders were owed, what's the total there? 187,500 on share capital, on share premium 287,500. So before we made this bonus issue, the total owing to shareholders on the statement of financial position would be the total of those two together. We've given them free shares. Again, they haven't paid anything for them, so the total owing can't change. And so, although we must increase share capital because there are more shares, we decrease the share premium. And remember, the total owing to shareholders is the two together surely, if one goes up and the other goes down by the same amount, the total owing to shareholders won't change. And so the final balance is there will be 900,000 shares in issue. Share capital, 187,500 plus 37,500 is 225. And share premium, 287,500 less 37,500 is 250,000. And so see what's happened. A rights issue is like we had before, the issue of any shares, debit cash, credit share capital, credit share premium with the extra. A bonus issue, no cash has been received, credit share capital, debit share premium, and the total owing to shareholders on the statement of financial position. After all of this, share capital, 900,000 shares, nominal value 25 cents, 900 at 25 is 225,000. Share premium, 250,000. The total 475,000. But of course, there's going to have been retained earnings as well owing to them. But that's not been affected and we don't know what it is. So there we are. It does need practice, but it's not hard. Just be careful, particularly when the nominal value isn't $1. It's easy to miss the fact that it's 25 cents or it's 50 cents or whatever. Secondly, although a bonus issue, with credit share capital, we have to debit something else. You would always debit share premium, because remember, share premium account can't be paid out as dividend. If there wasn't a share premium, we'd have to debit other reserves, we'd have to debit retained earnings, but we don't want to do that. Because if we reduce retained earnings, it reduces the amount they could possibly pay out as dividend. So we have to reduce somewhere, always in preference with reduced share premium. In the exam, it always would be share premium. A lot of people get upset about why on earth do they give free shares? Well, I'll tell you quickly, although it's not your problem for this exam, it's later exams where we could say a lot more about the reasoning. One reason is effectively to try and get rid of share premium. You know, why have two lines on the statement of financial position where effectively they are both capital? Well, you can save a line of printing if we gave them more free shares, you know, reduce share premium, if we reduce that down to 0 and increase share capital, it'll look a bit neater rather than having this silly share premium sitting around. The real reason, to be honest, I will tell you, but don't worry about this for the exam, is when a company has shares that are on the stock exchange, if the share price on the stock exchange gets very high, and the price on the stock exchange doesn't affect us at all for this exam, but if the price does get very high, people get scared of buying them. They're a bit silly, but they say, oh, if I've got $500 to invest, if I choose a company where the share price is $1, I can buy 500 shares. But if there's another company and the share price is $50, I can only afford 10. Doesn't that sound as good? Which is stupid. But because people get nervous when the share price is very high, companies often then do have a bonus issue. And if they gave people a 1-for-1 issue, you know, one extra share for every one they've already got. They've got twice as many shares, but the price on the stock exchange for each share will be half as much. So in total, they're still worth the same, but it's a way of getting the share price down. Now, I don't know, that may make sense, it may not, but it's not relevant for this exam, so I'm not going to repeat it. All you need to be aware of is a bonus issue, for whatever reason, is free shares. We increase share capital, we reduce share premium. All right. We're nearly there, but we're not there yet. I've been talking about reserves. And so far, we've dealt with two, and you know why. Reserves are extra owed to shareholders above the share capital. Retained earnings is profits less dividends, and that can be distributed. Share premium is a capital reserve. It's because they've paid extra for the shares. It's owing to shareholders, but it can't be distributed. There's one more reserve you need to be aware of for this exam. It's a revaluation reserve. I'll explain that in the next lecture.